Welcome to UBP TV. This is the back-to-school period, also for the Fed, so my comments will concentrate on the Fed strategy. What could be expected? We have seen recently a strong improvement in the US economy. We have a rebound in the manufacturing sentiment, a rebound also in the service sector. The domestic demand is more sustained, and the household's confidence has also improved. All in all, the GDP numbers is expected to continue to evolve around 2.5% in the next quarters and could reach 3% in the course of the next year. Of course, some news have disappointed. We have seen that the latest release of the non-farm payrolls have come significantly lower than expected and below 200,000 per month. And we'll also know that the decrease in the unemployment rate to 7.3% is largely due to a decrease in the labor force participation. Nevertheless, if we look at the chart, the decreasing trend in unemployment rate is obvious, and it is now totally in line with the Fed's expectations. If we look at the other measures of unemployment rate followed by the Fed, that is namely U6 and the augmented unemployment rate, the similar trend is obvious, that is to say, it's coming down from previous high levels. The Fed communication is clear and its strategy is transparent. With the decreasing trend in unemployment rate, the Fed should begin to reduce its monthly purchase of bonds in September. By how much? A cut by $20 billion per month seems too large, given the recent volatility of the monthly indicators. On the contrary, a cut by 10 or $15 billion per month should be a more reasonable and realistic scenario. The Fed should continue in the next quarter to reduce gradually its quantitative easing so that it will end in April or May next year after the employment has passed below 7%. A key question concerns the first rate hike. Officially, from the Fed, a rise is not expected before 2015. If we look at expectations for money markets, a first adjustment is already priced in for the course of next year. Of course, the scenario is heavily dependent from development in the economy and also the trend in unemployment rate and labor markets. So many uncertainties still remain on the agenda. So to summarize, a first step in reducing quantitative easing on September is expected from the Fed, and there is no risk of a specific liquidity crunch attached to this operation, because the balance sheet of the Fed should reduce gradually in the course of next year as the holding mature naturally. So the first step of reducing quantitative easing should not be a major constraint for the market. Thank you, and see you soon on UBP TV.